Q1 briefly explain on budgets and business planning process. Samsung is one of the world's largest companies within the field of electronics and advanced technology. The corporate makes a specialty of producing and manufacturing many different consumers and industries, such as digital media devices, electronics, memory chips, semiconductors, and integrated systems. The company is also involved in the development work likewise because of the Army gadgets. The corporate became one of all the most recognized brands within the technology field, and it produces around a fifth of the whole exports of Asian nation. Samsung was founded on the 1st of March 1938 as a trading store for groceries by Li Chow. Chow started the business in Daegu City in Korea by trading simple goods which were produced within the city and around it, and exporting them to China. By the 1970s, Samsung was able to expand and began the assembly of the raw materials of the textiles until the tip products, which made it one amongst the largest competitors within the textiles industry. Samsung was able to establish new industries like shipbuilding, chemical, petrochemical, and Samsung Precision Company, which helped Samsung to start to outgrow in a very promising way on budgets and business planning process. Figure 1. Samsung on budgets and business planning process. Planning. In the drafting board, the management makes organizational goals and creates a list of actions to realize. Within the starting stage, the management can discuss the various ways to achieve the objectives before deciding the most effective, thanks to having it all. During planning, management will do a deep analysis of the organization's vision, and also the thanks to using their resources to satisfy the objectives. Strategic planning is commonly done by the highest management in a corporation, which makes the goals to be achieved for the full organization. While doing the strategic planning, the highest management will analyze the threats which could be faced by the organization, consider the strengths and weaknesses of the organization, so create an inspiration of the simplest. Thanks to competing in such environment, which mostly is a long-term plan, Organizing needs a proper and clear structure of authority, besides the flow of the authority through the subdivisions aligned and coordinated in order that all are united and dealing together to achieve the objectives prescribed by the upper management. Samsung's structure may be a manifestation of the short evolution of their business from being a little trade into a world enterprise that invents and creates new technologies. With the involvement of its organizational structure in many alternative operations, the corporate uses many operation management strategies for various markets and fields. Effective penetration and development strategies for the market are happening through the company's corporate structure, which similarly gives it a plus within the competition of the market. Leading is about influencing employees' behaviors and motivating them to realize the objectives of the organization. Leading consists of managing people, like teams, groups, and even individuals rather than tasks. Although the managers could direct individuals in a very team by giving them orders and directing them. Successful managers are good leaders who connect with their employees by utilizing their interpersonal skills to motivate, inspire, and encourage team members to grant their best and improve their abilities. Managers can create a positive environment at their workplace by differentiating the moments when workers need directions or encouragement, and using positive support to administer a trophy or praise when workers have done their jobs in a very great way. Controlling is the process of doing the executing plans and adjusting them to create sure of achieving the organization's goals. During this stage, managers do tasks like training employees if needed and managing deadlines. Managers monitor their workers and increase the standard of their work. Managers likewise do performance appraisals to convey their workers' feedback on their performance and provide them still a positive remark. on the things they need to be executed in an exceedingly great way and on what they have to figure on more and improve. Managers could likewise offer a salary raise to well-performing employees.
So the question 2, formulate a sample cash budget and sale budget. Service steps in order to prepare a good cash budget. Step 1, preparing the cash received projection. Basically, the start line of preparing the cash budget is to try and do the cash received projection. The cash received include all the business cash inflow for given period. The projected cash received are into 3 main components are as follow. Forecast sales. These forecast sales are accustomed provide aid so as to calculate the projected cash received on the assessing from past experience. Cash sales. The cash sales has represent the 20% of money sales of the corporate collection of sites. These represent the gathering of its account receivable as a result of credit sales for every month support the past history. So now we get step 2 to prepare the cash disbursement project and also called cash payment. This includes all cash outflow of a business for a given period. Below are the common components of money disbursement. First one is cash purchase payment of account, rent or lease payment, wages and salary, tax payment, fixed side payment, interest payment, also like cash divide payment and others. Operator the cash receipt and cash disbursement projection. From step 1 and step 2 above, we are able to summarize the cash budget as so. For first one, beginning with the cash, assume that the start cash balance in October is actually 10K. Thereafter, the ending balance of October becomes the start balance of November then on. For the second part, the minimum cash balance, assume that the minimum cash balance for ABC company is ready at 20K months daily. For the third one, recurring total financing. This is often commonly from the notes payment. From the note payable, if ABC company doesn't have enough ending cash balance at the tip of every month above the minimum cash balance, then ABC company will finance through notes payable. So the first part, exists cash balance. The existing cash balance of 22K in October after accounting for the minimum cash balance may be invested within the marketable security.
Evaluate what to include in your business annual plan. First, read and understand the chief summary. The first step during a business plan assessment is reading the business executive summary. This could be a coin's elevator pitch, not a summary of a business plan. In 1 or 2 pages, it could convey the market opportunity and also the uniquely compelling features of the business that help it meet that chance. The chief summary should excite you and cause you to want to show it to the subsequent page. If it doesn't, the entrepreneur might lack marketing or writing skills, or it indicates that the concept itself isn't going to fly. Second, analyze opportunity within the market. Evaluate the market opportunity. Ideally, the market should be growing a minimum of 10% annually and have a considerably potential relative to the scale of the business and investment. The larger the potential market and therefore the faster it's growing, the greater the chance within the market. Look to the exhibits and appearance to confirm that business actually has done the mandatory marketing research and make a copy of any claims. Thirdly, evaluate the company's business strategy. Examine the corporate strategy for capturing its market. The plan must clearly describe the matter the corporate is solving or need its meeting for patrons, and so propose an answer. This is often the crux of a business plan assessment. This evaluation must take under consideration the merchandise or service being offered, the operational capacity and efficiency with which the business actually can produce its product, and therefore the quality of the proposed market effort. Fourthly, examine the business environment. The business plan should describe the competitive landscape during which the corporate operates, preferably by referencing Potter's 5 Force or another well-established tool. Search for detailed breakdowns and analysis of every one of its competitors, and of how the corporate is different and better than the competition in a very particular niche. This section should include the regulatory environment and mention any cost or necessary delays related to regulations. Potter's 5 Force is an evaluation model that appears closely at the 5 competitive forces at play within the business landscape. The forces are present in every industry, and by evaluating how they manifest in private industry, one can gauge that industry's strengths and weaknesses. Fifthly, evaluate the leadership team. Look for experience, integrity, and favor within the executive team. Read bios and brief highlights of every executive's strengths and expertise should accompany standard business information like headquarters and company structure. The corporate should have experienced advisors, either formally or informally. It is paramount that the principals involved within the business convey their passion and drive towards success with this project. If the founders haven't invested their own capital into the business or plan on keeping their day jobs expectations. Lastly, view the business plan as a living document. Evaluate the business plan as an entire document and as a mirrored image of a real-world company. Determine whether the market need is adequate, the company's offerings are compelling, and the management team experienced.
Question 4. Classify the common types of budgeting in business. Incremental budgeting. The normal approach noted above is additional called incremental budgeting. It generally starts with a previous year's number as a baseline, often combining last year's budget number with some years-to-date actuals, the remaining projections. The subsequent step involves modification to specific line items that involves predictable numbers or line items that there are obvious forcible changes. Expense on an amortized loan, for instance, will instantly increase over time because the principal portion of every payment declines. This payment often remains steady over a period of years in an exceedingly few cases. Manager is also responsive to expense categories that may sharply decline or escape altogether. Activity-based budgeting. Activities-based budgeting (ABB) may be a top-down approach that focuses on the key outcomes a business intends to attain. Activity-based budgeting tends to concentrate on strategic objectives and pays considerable less attention to expenditure that can't be tied on a high-level goals. As such, business leader must take care to not take the principles of activity-based budgeting too far. You will discount or overlook department that fail to provide specific measurable outcomes in commission of the company's strategic objective within the process. Nevertheless, activity-based budgeting generally provide a better level of strategic focus than the opposite approach on the list. Value proposition budgeting. The third approach is value proposition budgeting, which examines each line items or budgeting category to ask the question: why are we spending this money, and what value does it provide to our customers, employees, or other stakeholders? This approach may be a happy medium fitting between incremental budgeting and zero-based budgeting. Unlike the activities-based approach, value proposition budgeting seeks to justify spending for the worth they create, without requiring an instantaneous link to strategic goals in and of itself. Zero-based budgeting. Zero-based budgeting starts with a blank state. With this approach, managers must establish their budgetary requirements for the approaching year and justify each point without respect to previous year's members. Simply because the corporate spend money on a specific thing within the past doesn't mean it should necessarily still do so within the future. The zero-based approach requires that budget owners justify virtually every proposed expense. During this respect, zero-based budgeting a wonderful means of eliminating wasteful spending. It helps company leaders to aggressively streamline inflated budgeting and to bring costs to in restraint while minimizing any negative impact on operation. A driver-based budgeting. Driver-based budgeting focuses totally on the key variable that the majority drastically impact business performance and tie budgeting numbers to the physical resources necessary to attain the company's targets. This may include internal factors like the entire members of shoppers or subscribers, members of salespeople or distributors, or average revenue per customer. They may also include external factors like total market size, commodity price, or perhaps climatic condition. Driver-based budgeting builds a budget supporter key business objectives because assumption about external driver and a result-driven approach to internal business driver. The role of technology. Most companies default to use incremental budgeting, but partly because it's familiar, but also because it's historically require considerably less effort than an opposite method. Most companies today are recognizing that planning and budgeting should not be a new process. Instead, business leaders must constantly monitor external conditions and make rapid adjustment to remain earlier than competition.
1. Estimated revenue. There are two main components of estimated revenue: sales forecast and estimated cost of products sold or services rendered. If the business is quite a year old, then the experience will guide in estimating these components. If the business is new, you'll be able to check the revenue of comparable local businesses and use those figures to conservatively create some estimated revenue numbers. But whether the business is new or old, it's important to remain realistic to avoid overestimating. 2. Fixed cost. When a business pays an identical amount regularly for a selected expense, that's classified as a hard and fast cost. Some examples of fixed costs include building rent, mortgage or utility payments, employee salaries, internet service, accounting services, and insurance premiums. Factoring these expenses into the budget is vital, so you put aside the precise amount of cash required to hide these expenses. They will even be a decent point of reference to test for problems if business finances aren't going as planned. 3. Variable costs. This category includes the price of products or services which will fluctuate to support a business's success. As an example, allow to assume a product within the market that's gaining popularity. The subsequent thing preferred to do is manufacture more of that product. The prices of the raw materials required for production, the distribution channels used for supplying the merchandise, and also the production labor will all change after increasing production. 4. One-time expenses. These are one-off unexpected costs of business the business might incur in any given year. Some examples of these costs include replacing broken furniture or purchasing a laptop. 5. Cash flow. This is the money that travels in and out of the business. Get a plan of it from previous financial records and use that information to forecast earnings for the year budgeting for. If business encompasses a season, knowing when your income is highest will facilitate a plan for when to create large purchases or investments. 6. Profit. The final budget component is profit, which may be a number made by subtracting estimated cost from revenue. A rise in profit means your business is growing, which may be a good sign. Once got projected what quantity profit is likely to create in an exceedingly year, be ready to decide what quantity to take a position in each functional area of the organization.